Hopefully that worked. Sure. Let's see if I can figure out how to share
Do the left one.
the left one.
That shares the whole screen. Just
Okay, so everybody see the slide deck?
Yes.
Okay. So before we get started, last week we had no derivatives, and like we now do. So, Melina, have you had time to research that and want to talk to us about it?
Yeah, we did look into it, and it basically is that the debt team signed an agreement that is for the tax anticipation notes, basically with Wells Fargo, who would be loaning us that money, and it's just securing the principal and interest rate now, even though the transaction wouldn't occur for a couple months.
Yeah.
So it looks like it would be a loan commitment, which doesn't fall under the scope of some of those GASBs. So we don't have to do a whole bunch with that, which is nice news.
Yeah, maybe just disclose it in the subsequent events. And
yeah, I just added a sentence to the subsequent events for it, and I think we're good.
Well, that's pretty simple.
Yeah, a lot easier than we thought. So that's great.
Cool. Alrighty. Hello, chapter 28, other specialized items, compensated absences. And that kind of dovetails with the email I sent out for the new GASB 101 to redefine compensated absences. No, that doesn't start till FY25, I don't think. So we're still running on under the old rules for a little while longer. So what we're looking at is a cost of time that can be paid for at separation, such as vacation time, comp time, and then for police and fire sworn individuals or union contract has some sick time that they can get paid out. FPDNR is responsible for the PERS portion of the police and fire, which complicates the calculation a little bit. And we use the pay rates at June 30th and include all the variable fringe like PERS and FICA and Medicare and that TriMet tax. And so it's a T code. Well, actually, there's two T codes that have to be run. One of them goes into HCM, which is our payroll software, and it goes out and pulls all of the usage of pay types that we're wanting to look at. So I figured pulls it every time anybody in the city went on vacation or took sick leave or comp time for the entire year. Now, the year we're doing an estimate, so the year we use is June 1st through May 31st. So that's one T code. And we use that information to figure out the split between short-term and long-term. The second T code gives us the balance at May 31st in each of the pay types that we're wanting to look at. So it'll have everybody's hours of vacation time that are in their bank at May 31st. Now it gets dumped to a spreadsheet. And then we have to add, well, payroll adds additional columns to it. to calculate the Medicare and FICA, TriMet and PERS, and it goes and looks at the type of employee for PERS, because that determines whether, because there are different rates if you're tier 1, tier 2, OPSERP, and then for us, the IAP contribution is 6%, but for police officers and firefighters is 9%. So there are different fields that we dump down into that file that allows us to figure out that information. Now, this year we want to monitor this really closely because Stephen Barron has been doing this calculation. He's been running those T codes and building the workbooks, but he's now over in BES. Now, I don't know if he's going to help us some. That might be one thing that he could do, is to go ahead and do that, because that's due soon.
Yeah, he signed up. It's already due. He signed up to review it. But I could talk to Rod about having Steve do it instead.
And well, I think he may be back from vacation this week finally. So anyway, that's information, and we have to get that all done before we close AP 12, because it affects a lot of different funds. So we have to get that entry in before too much longer. And so anyway, now under GASB 101, it's really expanding the scope of our liability. So at this point, we're just the leave types we're looking at are like vacation time, which can be paid out when you leave, and comp time, which can be paid out when you leave, and that sick time for police and fire. And it's not 100% of it, but there's a formula you have to work through to figure out how much the sick time. But under GASB 101, it's going to be all of those, but then it'll be 100% of sick time for every employee. And management leave, we don't currently set up a liability, but it will be in the liability moving forward. And there are some other leave types that we'll have to add to the equation, because what they're looking at moving forward isn't what you would pay out at June 30th if everybody quit, but anything that can be consumed in the future. So anyway, it's gonna, the liability will grow dramatically.
What happens if people, when they quit, they don't get paid for sick time, right?
Right. Well, the police and firefighters get a portion of their sick time. Now, I think as a general rule, they don't put it into, they don't get it cash. I think most of them, what they do is that it's not a HSA, a health savings account, but it's something similar to that. I forget what it's called. So I think most of them have that money dumped into that. That way, I think they avoid taxation on it. Plus, it gives them a bank of money to spend on health insurance and medical bills during retirement. So I think most of them, the sick money and put it into that bank rather than taking cash out. But I don't know the exact percentage of how many do it that way and how many take the cash. So.
Or for the rest of them, then we'll just have to adjust the liability at the end of every year for that sick leave.
Well, it doesn't matter whether they're going to take it into the bank or take cash. We just assume that everything that belongs to them, we're gonna pay out, so the liability includes everything that they have, and I forget the formula, but it's like X% up to 500 hours, and then Y percentage for the next 500 hours, and so it's kind of staggered as to depending on how many hours of sick time they have sitting in their bank. So anyway, if you're interested, you can dig into those. I think it's like Schedule 26 or something. But anyway, you can drill into those workbooks and see how it's constructed if you're interested. But it's fairly complicated. I don't know. I worked with EBS and built those T codes, and I did it for a couple of years, but then payroll decided they didn't want anybody outside of payroll getting into payroll information, so they took it over. So, other specialized grants, expenditure driven. We obtain a claim by incurring eligibility requirements, spend the money, and then the bill for the reimbursement. And up until the last couple of years, pretty much all of our grants were expenditure driven. They run through the grants fund. So Fund 217 is a grant fund, 218 is CDBG, 219 is home. And those have been primarily expenditure driven stuff. But CARES 2 years ago and ARPA now, we're getting advances. So it's a little bit different now, but we still can't recognize the revenue until we've spent the money on eligible expenditures. Even though we've got the cash in the bank, it's offset by unearned revenue until we actually spend the money. Entitlements and shared revenue, formula grants. So performance isn't the basis for recognizing revenue. Generally, it's tied to a period of availability, and state sharing of gas taxes, liquor taxes, cigarette taxes, and cannabis taxes are good examples of those types. And they're called formula because like gas tax, I think that is kind of a combination formula where it's built on combination of population and lane miles of streets within the city. So they're using those two factors statewide and figuring out how much of the gas tax to allocate to cities and counties all across the state. And there are similar type formulas for figuring out how to allocate liquor tax and cigarette tax and cannabis tax. And now for cannabis, this is not our, because we have our share of the state revenue, which is what we're talking about here. But then we also have our own cannabis tax for just city of Portland. So that's a different type of taxation. It's pretty much like a sales tax type thing. Endowments intended to be invested rather than spent. We just have a small amount here. It's in our permanent fund, 500. And this is where people have donated money to help parks. And we can only spend the interest on it. And it's the interest earnings on this is just tiny. So we're really not able to do a whole lot with this. Commodities, so like school lunch programs. And it's recognized at the acquisition value when received. Pass-through grants. Most require some administrative involvement. For instance, determining what subrecipients are eligible, and then we have to do monitoring. But if we're if all we are is a conduit from the federal government to some other agency, and we don't do anything administratively, we don't decide who gets the money or what they do with it, we're just a conduit. And there are, I can only think of one here, it was some kind of technology grant. But there, instead of running it through one of our governmental funds, we run it through a custodial fund. And it's just an inflow and an outflow over in the custodial fund. So for the other type of pass-through, we haven't had a massive amount of those type of grants in the past, but both CARES and ARPA were passed, and ERAP. We're running a lot of that. It comes into the city and then we're passing it on to some nonprofit who's actually running the program. So ERAP is the rental assistance one. And it looks like we're just getting another 25 million. So I think we've gone through about 30 million so far, and this will be another 25. But Home Forward, which is Portland's housing authority, has been managing that particular program. So the money comes to the city, we pass it on to Home Forward, and then we have subrecipient monitoring requirements. Now, that involves, so in uniform guidance, which is what OMB created a few years ago, that covers all of the rules for how grants are run, but how federal grants are run. And within that, it's got the cost principles, which tell you what you can spend money on. It's got the auditing requirements and a whole bunch of other stuff. But part of what's in there is it tells federal agencies what they have to do when they're selecting a recipient for their grants. And those requirements pass through to us. And so that basically requires us to do a risk assessment on the entity that's going to be receiving the money and determine whether we think they have the capacity to deal with it. Now, even if we don't think that they have the capacity, we could go ahead and give them the grant, but then we have to adjust our subrecipient monitoring accordingly to ratchet up how much work we're doing to monitor to make sure that they're actually spending the money in compliance with the federal grant requirements. So it's something we have to go through on each one of these that we're doing now, and it's been challenging because a lot of these nonprofits that we're passing money through are pretty small and haven't had audits before, and haven't had single audits before. Now, kind of the threshold, well, definitely this, well, yeah, threshold for having a single audit is 750,000 of federal money. And Treasury worked with the AICPA to come up with an alternative approach for the ARPA money. And basically what it said is, okay, you've got more than $750,000 of grant money. Okay, so let's look at your CFA, which is your schedule of expenditures under federal programs. So the CFA lists out all of your expenditures by grant and comes to a total. So if all of your grants exclusive of ARPA are less than 750,000, but with ARPA it goes over 750,000, then under the AICPA rules, you can do just limited procedures. You don't have to actually do a full single audit. You can go in and do a simpler process to figure out whether they spent it correctly or not, which is helping out a bunch of these small nonprofits that never had any kind of a audit before. If I remember correctly, one of the requirements for a single audit is if you didn't have a regular financial audit in the prior year, then I think you really have to go back and have one done, which you're starting to get into a lot of expense for some small entity that really hasn't had that in the past, had to deal with audits in the past. So anyway.
Is that 750,000 in total for the whole city, or still Marlboro, or per sub-city?
Well, it doesn't apply to the city, it applies to the nonprofits. So if you got nonprofit X that's receiving $800,000 from the city under ARPA, but has 10,000 of other grants. So you look at the 10,000 of other grants, and that doesn't exceed 750,000. But with ARPA, your CFA is now over 750,000. So that nonprofit could opt to just hire a CPA firm to do the limited procedures and not do a full-blown financial audit and single audit. So it's, well, and realistically, I mean, the AICPA got involved with this because it became obvious really, really fast that there just aren't enough CPA firms in the country capable of doing a single audit to handle every nonprofit that is going to would have needed a single audit. So it was going to be a situation where if the Treasury continued to require a single audit, it was going to take years for the CPA firms in the country to actually finish all of them. So it was pretty much a workload driven exception that was pushed through. So they're able to do an agreed upon procedures, basically, under the test standards, and just go in and perform limited procedures on the ARPA money to validate that it was spent correctly. On behalf payments, so like Montana pays a portion of the pension premiums for all governments in the state, and it goes straight from the state to the pension plan. And for on behalf payments related to personnel costs, revenue and expenditures are recognized. And that's a carve out I think it was GASB Interpretation 6. That allowed this just for personnel costs. So if some other entity is paying for streets, it isn't recognized as revenue and expenditures for the modified accrual. It would be recognized as like a developer contribution for accrual-based financial statements. But you can't record it for modified accrual. But there is this one carve out for if another entity helps you with your personnel costs, you can record it in the governmental funds for as revenue and expenditures. Irrevocable split interest agreements. There are multiple parties receiving proceeds from a trust. And the government could be the lead or a remainder interest. And there's a fairly new standard that talks about this because there's all sorts of weird possible situations you can get into where a citizen dies and I'll take a house that they own and have lived in, and they figure, well, my kids are actually going to want to live in this house, so they'll leave the house to the city or the county or the state, but then have a clause in there that the kids can live in that house and as long as they're alive. So the remainder interest after the kids die then reverts to the city or the government. But we'd have to, if we get into situations like that, we would need to actually go back to that new standard. And life interest, that's a variation on that where somebody's still alive and they donate the house to the city, but they want to live in it until they die. Non-exchange financial guarantee. Three parties, issuer, debt. Three parties, issuer, debt, entity entitled to the payment, and a guarantor. So the government reports in their statements only if required to pay. So that's the kind of situation where, like, if Home Forward wanted to tap into our AAA bond rating, we could work a deal where we're kind of issuing the debt in our name, but it's really Home Forward that's going to receive the proceeds and they're going to make all the payments. And we don't have to put it on our books. And that's Home Forward goes under, and we end up getting stuck with a payment.
Is that what happened with that solar enterprise that we had to pay for?
Yeah. So we have gone through that where that was a private corporation, I think. But in order to help underwrite that particular solar business, we kind of guaranteed their payments. And when they went bankrupt, we got stuck coming in and picking up the bill. So those sort of things do happen. It's pretty rare for us. Leases, financing of a right to use an underlying non-financial asset. A contract that conveys control of a right to use, and control is obtain and relinquish present service capacity of an asset. acquired and relinquished right to determine how asset is used. Yeah, less than 12 months with no option to renew, that's short term. If the ownership transfers, it is a finance purchase, not a lease. Now, I actually came up with a control question last week, because Clean Water Services has a deal where they're leasing out farmland, but Clean Water Services reserves the right to come in and out and do work on the riparian section of that land. And there's in the Q&As and the implementation guide for the releases, it talks about a similar type situation. And there, GASB said it's not a GASB 87 lease because the lessee did not have total control over access. Clean Water Services continued to reserve the right to come in and do whatever the heck they wanted, and even destroy the crops if it served their benefit. So that is an interesting one. Also, it's really small. It's like $800 a year for another 3 years. So it really wasn't material to speak of.
I think most leases would have some kind of term like that.
Yeah.
Give a lesser control.
Yeah, I think a lot of our leases have something like that, but it's more like if it's a building, it would be like we're able to come in and do maintenance or something like that.
Yeah. Yeah. I know the last two property leases I was in when I was a renter, they reserved the right to come in and inspect the place. So yeah, you're getting into a little bit of a gray area there.
Seems like it, yeah.
But the fact that Clean Water Services reserve the right to destroy the crops,
Yeah.
which kind of eliminated any benefit to the tenant has. Now, what are the probabilities of them actually doing something like that? It's must be pretty low, or the farmer wouldn't have agreed to do it. But so anyway,
Interesting case for sure.
yeah. So lease term, non-cancelable period, neither party can cancel without the other's agreement. Plus the options that are reasonably certain will be exercised. And that was another question she was wondering about, was with cell towers. There were a whole bunch of, in their contracts, they got a whole bunch of options to renew. But when she went and talked to her people about it to find out whether they thought that the options would be renewed, they were uncertain because technology keeps changing. Like I know with 5G, those cell towers have to be lower to the ground, and they have to be closer together in order for 5G to really work. So it could be that as the technology changes, where they have a cell tower might become useless. So that sort of thing can factor into your decision making. So the lessee records the liability, an intangible right of use asset, for the present value of the payments that are fixed in substance. Add any purchase options to valuation if likely to be exercised. Variable payments if based on an index or rate. And if assumed termination include a penalty, less any lease incentives, and then use the borrowing rate if not stated in the contract. So I'll stop. You guys are more familiar with me than I am at this point, because you've been doing this for full time for a while. For lessors, we record a long-term receivable and deferred inflow. Valuation is done similarly to lessee leases. The city isn't implementing GASB 87 for budgetary. So we have chosen this option since we don't want to bother council with changing the budget every time a new lease is signed. Now, we really wouldn't have to bother them for a lessor lease, but for a lessee lease, we would have to go in and get approval for a capital outlay for the net present value of the right of use asset. So a little bit annoying, but anyway, CBO didn't want to implement it, so we didn't. And then this doesn't impact anything that's going on inside of the city. Now, another issue here is how do you amortize the deferred inflow? And so where the right of use asset, we're amortizing that on a straight line basis over the life of the asset. There are some governments that are amortizing the deferred inflow over the term of on a straight line basis over the life of the asset. But we opted to amortize it at the same exact way that we're amortizing the long-term receivable. So those two numbers are going down and are always equal to each other. Primarily because that will, for the budgetary statements, that gets revenue tied to the actual cash transactions. Where if you were amortizing the inflow on a straight line basis, that amortization goes to revenue. And so we would start, for modified accrual and budgetary basis, we would start getting away from cash recognition if we did that on a straight line basis. So we opted to amortize them both identically. And GASB doesn't speak to it. It just says you have to have a rational and systematic method of amortization, and doesn't really tell you how you accomplish that. So special assessments. It's an exchange transaction. And they're basically a user fee. So what's happening, we call these LIDs. I think we've talked about this in a previous one. So limited improvement district. Montana calls them SIDs, special improvement district. And there are different names in different states depending on state laws, but they're all conceptually the same. Or the property owner approaches the city about adding service they don't currently have, like sewer, water, sidewalks, or paved streets. And if approved, an LID is created. Bond proceeds are given
Hello, yes?
Got anybody here?
Yeah, we can hear you now.
Yeah, you're unfrozen now.
Can you see the slides?
No, you'll have to reshare.
How about now?
Yes, thank you.
Okay. So LIDs tend to get paid off quickly oftentimes. Sometimes people just don't want to lien on their property and they go out and issue. They'll just come in and pay them off. Second thing that happens is this is a lien on the property. And if the house sells or if the owners refinance, then the bank isn't going to want to be in a second position. So the bank will usually require as part of the transaction that the assessments are paid off. So anyway, this type of receivable tends to get paid off pretty quickly. Now I'm kind of oversimplifying here because it's often, although it is oftentimes driven by people in a neighborhood wanting something, 100% of the people in the neighborhood probably don't want it. So you have to create the area that you're going to want to work in, and then figure out kind of what it's going to cost, and then how much each property owner is going to have to pay, and it's oftentimes determined on the frontage of the property. So if you have a really big lot, you're going to have a higher portion of the total LID that you're going to have to pay, or if you have a really narrow lot, and it's going to be less. So the city will figure all that out and then go around to the people in the neighborhood and get people to sign up and say, okay, yes or no, I'm in or out. And you have to have a majority of the people in the neighborhood wanting to be in order for it to move forward. So, and it can be contentious. There was one at last week's city council where the property owner had a really, really big lot. So their share of the LID was really big. And they were elderly and didn't want to participate. But the majority of the people in the neighborhood really wanted in. So it ended up happening. So it's more complex than what I've described here, but for our purposes, this is probably sufficient. Now, under current modified accrual rules, we book the entire assessment receivable, which is could be 20-year receivable on most of these, because we're issuing 20-year bonds, so we're assessing the people over 20 years. And then everything but what we anticipate collecting in the first 2 months of the subsequent year is set up as a deferred revenue. So the vast majority of the receivable isn't showing up in fund balance. Now it does show up in that position because we get rid of deferred revenue for accrual-based accounting. Now, under short-term accounting, they're proposing to just eliminate these receivables altogether. So that will be kind of interesting change. Now, I personally think you probably, if you're really talking about short-term accounting, the next 12 months of receivable should be booked. But in the last exposure draft, GASB was not including that as one of the things that it was allowing. So anyway, around December of 23 or so, we should be seeing that final and start figuring out exactly what is going to happen. But my guess at this point is this will just disappear from short-term accounting and just be an accrual-based receivable. Sales and pledges of receivables. We haven't done this. Government combinations. We haven't done that in many years, but over the years, the city has absorbed a number of water districts, and we have done. I think there's been some smaller communities in the past that have been annexed in. Joint ventures, we don't have any. I think it was last week we talked about risk pools, where a bunch of governments in Montana, all the cities, each joined together to form a statewide risk pool for cities, and that's kind of that's a joint venture type thing. Majority equity interests, we don't have any of those. Service concession agreements, so that covers things like the Moda Center. But in order to scope the Moda Center or these other venues, and we would have to control the ticket prices and some other things. So that there were some things that we just couldn't scope in because it just didn't fit the contracts that we have. And Oregon doesn't allow bankruptcies. Now, sales of receivables, it's conceivable that could happen sometime. We've got hundreds of millions of dollars worth of loans receivable. So selling that portfolio could be a way to bring in some additional money for low-income housing work. But it's so heavily discounted because of the terms. I don't know if we could even find a buyer. So anyway, these type of things really are a low probability for us. But they do affect some other governments. Summary of significant accounting policies, affectionately known as the SOSEP. So it's our first note disclosure, and it's where we discuss specialized environment. I guess I should flip back here. And see if I have any links. So it looks like I got one here. So we discussed our specialized environment selection among GAAP alternatives and application of professional judgment. And I'm guessing this is our SOSAP. So can people see that?
Yes.
Okay. So we started off and talk about the reporting environment, which just kind of describes the city. And then we talk about our component units, which our blended component unit is FPD&R. And then we talk about our discretely presented component unit, which is Prosper. And then there's some boilerplate talking about how government-wide and fund financial statements work. So it's kind of describing our bases of accounting and measurement focus. And then we talk about our major funds. And then we kind of describe the different fund types that we have. And then some general stuff about things, about how we do accounting. And then we talk about specific fund changes during the year. So we added the Parks Levy, Airport Way. And then we go through and talk a little bit about each of our assets, liabilities. Just so that people have an understanding of what we're doing. That helps put it into context, and there are options like with inventory. If you can use purchases or consumption, and then here we talk about in general what our lives on our assets are, and our decision not to book the historical treasures and art. Just runs through all the different things on the balance sheet. And then some of the other elements like cash flows and estimates. Then we talk about our stabilization arrangements. So we have a reserve fund for general fund and treasury and transportation. In order to set aside some money in case of emergencies. And then we talk about adoptions of GASBs and future GASBs that are coming up. So we'll have to add 100 and 101 here. Well, 98 and 99. Let's see, 98 I think was Oh, well, there's one we missed. Because we early implemented 98. I think that was the one that
Change the dates.
you do act for.
I missed that.
So we forgot that we early implemented that. So we might get dinged by GFOA over that.
I think we missed a couple standards last year. And it came out because the auditors caught it for MHCRC, but they didn't catch it for our financial statements.
Okay, so we'll get dinged by GFOA for missing those. And we should be hearing soon. I talked to them when I was in Austin. And they were saying that it's taken them about 8 months to review. So we should be hearing anytime. And we call it note 2. We break out stewardship, compliance, and accountability. So we talk about budget, expenditures in excess, deficit fund equity, which it really isn't. We probably should say net position too, because we're talking about P&D having negative net position. So its fund balance is fine. Budgetary fund balance is fine, but its net position is negative because of the pension liability. Now that will go away. Not exactly sure when, but P&D is being absorbed into BTS at some point. So we'll have one less internal service fund. So anyway, that's kind of what the SOSEP looks like for us. So we describe significant accounting policies, component units, describe government-wide basis of accounting, major funds, budgetary basis, expenditures over appropriation, and describe the different elements of the balance sheet, assets, liabilities, inflows and outflows. That may be one thing we might just tweak that description, because when we go into talking about assets and liabilities, I don't think we say deferred inflows and outflows too.
Brings us to 4 o'clock.
Okay. So we'll start next time on 105.
Thank you, Ron.
Thank you.
Sure.
Thank you.
Yeah, see everybody tomorrow.
See ya.
Tomorrow.
Thanks.
Don't forget to stop recording because we can all see your screen too.
I gotta find a.
You could probably just hang up and it'll stop recording.
Yeah. Probably.
There you go.